Good day, and welcome to Q4 and year-ended FY23 earnings conference call of the ANUP Engineering Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known and unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that the company have uploaded the results, press release, investor presentation, and also the outcome of the board meeting on the website of stock exchanges and website of the company. I now hand the conference over to Mr. Puneet Lalbhai. Thank you, and over to you, sir.
Very good afternoon to everyone on the call. It's a great pleasure to interact with you all today. We've seen a very uncertain and difficult year due to global geopolitical situation, and in that I am very happy to say that the team at ANUP has come out with a good performance. And to take you through the details of the year and the quarter, I now invite our CEO, Mr. Reginaldo D'Souza, to sort of give his presentation, and then we'll all jointly take the calls. Thank you.
Thank you so much, Puneet Bhai. Hello, everyone. Greetings from Team ANUP. It's wonderful to be with you all again as we close the year FY23 and embark on our growth journey. We are truly grateful to all of you for your support, your confidence in our business, and being with us as we take this growth journey. The year FY23 has surely been a challenging year with geopolitical uncertainties, supply disruptions, volatility in raw material prices, impacting even the logistics side with challenges on shipping availability and cost. But with a strong resolve of our spirited team at ANUP and our partners, we were able to sail through and end the year on a decent note. Talking on the market side, the story has been favorable with many projects kicking in and also order release from our customers being concluded. We booked around 500 crore plus new orders in the year FY23. This has ensured a healthy opening balance of around 500 crore plus as we began the year FY24. This favorable trend has continued, helping us book over 150 crores, 150 crores already in this year till date. Of course, most of them executable in the year FY25. Now talking about our performance in quarter 4, we achieved a revenue of 144.2 crores against 100 crore quarter-on-quarter of last year. That's about 44% improvement over last year. With an EBITDA of 30.2 crores against 23.8 crores quarter-on-quarter, that's about 26.8% improvement. For the year ended March 2023, if you look at the whole year, FY23, the revenue stood at 411.3 crores, 411.3 crores against 288.2 crores in the year FY22. That means it's a growth of about 42.7% to be precise, with With an EBITDA of 82.7 crores, that's 20.1% against 70 crores in FY22 at 24.3%. That's a change of about 18.2%. PBT is at 70 crores, 70, that's 17%, against 61.1 crores last year. That's 21.2%. That means it's a change of about 14.5%. The PAT is at 51.4 crores at 12.5%, against 62.1 crores, that's 21.5%, a drop of about 17%, but that's mainly due to the tax reversal that we had in the last quarter of FY22 of about 15.5 crores. So if you take a net off for the tax reversal, our PAT for this year stands at 51.43 crores against 46.49 crores last year. So we have made some improvements even on the PAT net of the tax reversal. The working capital has improved from 155 days to about 148 days, 148. And also we have maintained our position of almost being debt-free even with our new investment in the new facility at Kheda. Our exports revenue stands at 19%, which I did mention on the call last time that this is a very important factor for our business. So it stands at 19% for FY23. And on the product portfolio side, heat exchangers still remain dominant at about 74%. So we are almost there year on year on heat exchanger component being around that 74-75% mark. So this was the performance of FY23. So now how do we see ourselves in FY24? As I mentioned, with a very healthy order book of about 530 crores opening, we expect to continue our growth of 25 to 30% with an annualized EBITDA of around 22%. Our export is expected to grow to 30% of our sales revenue. So this is what I said earlier. Last year it was 19%. We expect it to grow to about 30% in this financial year, that is FY24. So what's important for us? We will continue to focus on consistent quarter-on-quarter performance. I'm sure you would have seen our last 3 quarters, which were all 100 crore plus, and we, as a team, wish to continue and ensure this consistency going forward. On the capacity front, I am happy to share that our new facility at Kheda is now ready with the trial production on. So we are placed very well on that front, which we've been discussing over last couple of calls. So this new Kheda facility, which is about 40 kilometers from our existing facility in Odhav, will surely help us boost our revenue in quarter 3 and quarter 4, with the first dispatch from that plant expected in August 2023. I'm also happy to share a dividend of 150%, that's 15 rupees per share, which translates to about 29% of PAT. I'm sure this clearly demonstrates our confidence in the business, its growth journey, and what the future holds for us. So with this, I end my small briefing. Thank you once again for being strong supporters in our growth journey and for giving us your valuable time today and a patient hearing. Thank you once again, and we will be happy to take your questions, if any.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Tushar from Kamakhya Wealth Management. Please go ahead.
Yeah, good afternoon, sir, and congratulations for your good set of numbers. Sir, I just want to understand the revenue potential of the Kheda facility going forward, and also the incremental bay which we can add in every phase we come going forward. That would be my first question, sir.
Reggie, I think you are best placed to answer, the potential of the capex that we have done, plus how we are looking at the future.
That's right. Right. So as we discussed over the last call, in Kheda, in the first phase we have this 1.5 bay, literally, which we have built and which is operational now, ready to kickstart commercial production. In the first year, we are expecting a revenue of about 60 crores coming from that plant. Of course, that's the first year, so we need some time to stabilize, and that's the reason it is 60 crores for this year. Going forward from next year on, when we have the full complement of 12 months at our disposal and the plant completely stabilized, we can look at a turnover of 150 crore plus. Of course, that will all depend on the product portfolio that we are able to get from the market. But at a broader level, I would say 150 to 200 crores is what we can look at Kheda.
Fair enough, sir. And sir, the guidance which you give of 25 to 30% CAGR for next 2-3 years, what would be the margin for those? And in the past, you have mentioned the long-term guidance of 1,000 crore till FY27. So do we hold that?
Yes, we very much hold that. So even at this 25 to 30% growth, if you work out the arithmetic, it would come to that. So we hold on to that. And on the margin side, we are looking at, as we grow, we obviously, as I explained last time over, as we grow, we will have to move to a little more complex and higher metallurgy products, where we are expecting to maintain a margin of 22% plus.
Sir, my last question. So this IOCL is expanding their capacity from 3.2 billion metric ton to 6.8 billion metric ton in the next 3 to 5 years. They also came up with the petchem facility of 61,000 crore in the Odisha. So I just want to understand how the bid pipeline is looking and what would be our conversion from that bid pipeline in the percentage terms.
Yeah, so you're right in whatever you mentioned about the projects. In addition to that, there are many projects which are kicking on. So on the market side, we see a very good traction. We are good on that. Overall, on the inquiry side, the conversion side, we are at about between 15 to 20% conversion. That's more to do with our choices that we make. Of course, it can be higher if we have to make a choice, but considering our growth aspirations and along with the profitability that we desire, the conversion is about 15 to 20%.
Fair enough, sir. Thank you and all the best.
Thank you so much for your question.
Thank you. The next question is from the line of Niyasar Parikh from Native Capital. Please go ahead.
Hi. Thanks for taking the question. My first question is on, can you give some sense of the sector split, end industry split for your business currently, and the new orders, pipeline, etc., which are the sectors that you are seeing more traction in?
Yeah, so I'll take that. So on the sectors, oil and gas and petrochemicals has always been dominant for us. And even in this order book that you look at, you'll see a dominant portion coming from oil and gas and petchem. But having said that, that chemical industry is also growing. and lends a lot of growth for us. So that's about 11% right now. But of course, dominantly it is oil and gas and petrochemicals.
Okay, understood. And in terms of competition, bunch of people are obviously, growing or aggressively increasing capacity in your space as well, including people, larger players like startup projects and all of that. So are you seeing increased competition and pricing pressure, on your products in the market?
Yeah, so let me just make a small clarification there. Tata Projects is generally our customer. They are the EPC company, so they are our customers. Of course, as you rightly said, the capacities are growing, but in the same breath, the capex cycle is on the positive side today. So based on our analytics, we are very confident of the share of growth that we need in the market.
Got it. And last question on the margins. You obviously mentioned 22%. In this quarter also it was a bit subdued. But if we look at your order book, that you have 530 crores, and assuming the current prices as they are, how do you see the margins on that for the next year, or in the next? How should we think of that? And is there any scope for improvement over there?
Yeah, so in this current year that we speak about, FY24, we see EBITDA levels at about 22%, as I mentioned, because we completely have the order booking on our hands today. So we very clearly have a handle of the numbers. And going forward, as I mentioned, our growth aspirations are there in the line of 25 to 30% year on year, with an EBITDA margin of 22% plus. That's going to be our guiding principle going forward.
Okay, got it. And just maybe the last thing is on your working capital cycle, right? It's obviously elongated. Is there anything that we can do to bring it down? Or are we doing anything to bring it down?
Yeah, so you rightly said it's a long gestation project. So our cycle terms vary anywhere between 10 months to about now. As we move up the ladder in terms of product complexities, it would go even up to 14 months. So what we are focusing internally is just to give one pitch of what we are doing is focus on consistent quarter-on-quarter performance. I'm sure you would have seen the last 3 quarters that we had was all 100% plus, 100 crore plus, which historically you would have seen a spike. So that's where the focus is, so that we get our collections on time, we get our monies back on time, and improve our working capital. That's the predominant focus that we have, considering that we have long cycle projects on hand.
Okay, got it. Thank you so much. I'll come back in the queue.
Thank you so much.
Thank you. Next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Namaskar, sir, and thank you for the opportunity.
Saket, you're sounding very distant. Can you speak through?
Now can you hear me, sir?
Yes.
Oh,
thank you.
Yeah, thank you for correcting me. And namaskar, sir, and thank you for this opportunity, firstly. Sir, when we look at your order book currently at 530 crore, does the impact of the higher the raw material prices and the lower margin profile is now totally executed, and now we are back to the old regime of this 22 to 22% margin that we will be expecting going ahead?
Yeah. So, Saket, thanks for your question. Yes, if you recall our words in the last call, we wanted to close all the executions of the past which had this high material cost impact, because of which we had projected lower EBITDA last year. But there was some realignment of some of the projects where the deliveries were a little postponed from the customer's end, or we realigned it. So with that, some of the is still pending in Q1 and a little early in the Q2. But largely, to answer your question, yes, the challenge that we had of the past in terms of raw material price currently is out of our way. It's only whatever is on our plates we are executing. All the new orders that we are, so you see a very healthy EBITDA levels, 22% plus in Q3 and Q4. On overall annualized level, we will be surely 22% plus.
So you are referring to quarter one and quarter two will have some impact of the. Hello.
Hello.
Yes, sir. You are articulating to have some impact on the Q1 and Q2 numbers on the margin front, and Q3, Q4 will have the higher margin profile.
Yes. So at EBITDA levels in Q1 and Q2, you'll see around 20 plus number because we will complete all the executions which were pending of last year. And Q3 and Q4, you would see at a much higher level. So on an annualized basis, you will see 22% plus.
Okay. Right, sir. Sir, when we look at this capital work in progress, the figure is now at 87 crore. So, what should we be capitalizing it once Kheda is commissioned, sir? What portion of this 87 crore will get capitalized?
We would be capitalizing the complete 87 crores, sorry.
87 crore. And this will be for this first quarter itself, sir? I missed your deadline, sir. When will Kheda get commissioned?
Yes, in quarter one.
In quarter one itself. So what would be the depreciation impact, sir, for the 9 months? For the entire year, I think so.
Around roughly 4.2 crores.
4.2 crores. And now, sir, coming to the profile for our order booking, I think so, sir. You spoke about 30% of the total order book to be executed towards the export segment, and the order book itself stands now at the same mix. And earlier also in our last conversation, you did spoke about garnering more orders from other geographies. So if you could give us some more color how the pipeline is there in terms of the export market, and what are we eyeing in terms of in improving our order booking going ahead in terms of the export?
Yeah. So of the 530 crore opening balance that we have this year, that is financial year FY24, we should be about 30% on the export side. So from 19% in FY23, we move up to about 30% export. And I recollect on the last call, we did say that we have a plan to go up to 40% in 3 years horizon. But we should look at 40% by FY25 on export side. Overall, on the market side, the export, the traction is we are feeling right now is very good. In fact, the last couple of months, the order booking that has been there has mostly come from export. I would say about 75 to 80% has come from exports, which was a focused one, of course. We targeted those and we could win them. So all in all, on the market side, the scene looks pretty good on the capex cycle. We have been successful in the export orders, and we wish to take this export portion from 30% to 40% by FY25.
Okay. And one small clarification, sir. This 530 crore is executable over the 12 months, and the 150 crore order intake takes our order book, closing order book as on 17th May or even date to what figure?
Yeah, so this 530, I would not say 100% executable, give and take here and there, some which are greater than 12 months and 13 months of execution would move some in that. This 150 crore plus that we have booked in this year, some of them would be executable. So overall, it would give a bunch of sales order that would give us a 30% growth for this year.
30% growth on revenue terms.
That's correct.
So we are eyeing to close this year on a top line growth of 30% on what we posted for FY23. with an EBITDA margin in the vicinity of 20 to 22%.
That's correct. So I re-clarify. So we stand with our growth aspirations of 25 to 30% year on year. 30% looks very strong for this year with a 22% plus EBITDA.
And sir, can you give me the closing order book number as on date, sir?
So we opened the year at 530. We booked about close to about 150. So that's about 680 crores.
Okay, and there will be execution as of now. That will be the normal course of business, right, sir?
That's correct. So you would say on a round of figure, 150 crore plus would be already for FY25. So in short, the order bookings that we are doing now going forward is for not this year but financial year 25.
Right, sir. And sir, thanks to the board for increasing the dividend payout, sir. This gives a clear indication on sharing the cash with the investors. Thank you, and I will join the queue.
Thank you so much, sir. Thank you for the confidence in our business again.
Thank you. Thank you.
Thank you. Next question is from the line of Abhishek Agarwal from the Ready Investments. Please go ahead.
Good afternoon, sir. Thank you for giving me opportunity. So my first question, how many orders are you expecting in FY24? And out of that, how many orders are for Kheda plant? That's my first question. And the second question, when will we start doing capex in a Kheda phase 2 and how much will be the capex? So will we take any loan or raise equity for capex?
So let me try and answer that. I think, as Reggie has just mentioned, that we want to target the 25 to 30% growth year on year. So the arithmetic is simple. If you are at 530 and you add on 30%, you have to book that much or more orders in this year. And I think the way the year has started, the team is pretty confident in doing that. As far as Kheda is concerned, since we are just starting out, the real dispatches will be only in Q3 and Q4 this year, to which Reggie has already answered that we are probably going to have about a 60 crore kind of turnover from Kheda. But the investment that has already been done should take us anywhere between 150 to 200 at a good capacity utilization. And I suppose we can anticipate, kicking off an investment for the next phase sometime during the next financial year, so that we are ready with the, and that would be 80 to 100 crore kind of capex that will ready the next 150 crore kind of turnover that we can expect from the as that stabilizes and goes towards utilization. So that's a brief idea of how we are planning to invest.
So in phase 2, 80 crore capex will be done from internal accrual?
Yes, more or less. I mean, that is the plan. And if this 30% growth and profitability expectations are met, then this should be we should be all on track. But we'll have to, of course, based on the detailed cash flow working, we'll have to probably decide closer to date as to whether everything is matching up, there are no timeline mismatches, etc. So very hard to confirm that, but as far as possible, we will try and keep it that way.
And sir, last question, how much capex was done in FY23 and how much will be capex in FY24?
So Reggie, we have those numbers on hand.
So in FY23, we've done 47 crores. Sorry, 75 crores.
Okay. And for FY24, what is plan for capex?
47. So if you remember, we had articulated that it will be roughly about 120 crores of total capex for Kheda. So So that's the breakup. So 47, which I spelled it wrongly earlier, it was for FY24 and 70 plus was for FY23.
Okay. Thank you so much and all the best.
Thank you so much, Abhishek.
Thanks.
Abhishek, do you have any follow-up question?
No, sir. Thank you, sir.
Thank you. Next question is from the line of Sonia from the London Broadshaw. Please go ahead.
Thank you for the opportunity. Sir, I just want to understand, I just want to have some details on other expenses. If we look on quarter-on-quarter basis, other expenses has increased from 164 crores to 286 crores, on YOY basis. Even in last quarter on YOY basis, there was sharp jump. So can you share some details on this, that why it has increased so much? Hello?
Yes, we got a question. So if you look at on the other expenses, if you look at the product portfolio that we have executed, most of the projects that were executed were Helix exchanges, which is a licensed product from Lamasi Transfer. And for these kind of licensed products where we have a licensee agreement, we need to pay up some royalties. So these are royalty payments which normally kicks in once we execute this particular order.
Okay. So is this expected to continue in coming quarters, or it's one-off kind of a thing?
No, this will continue based on the product portfolio. So if the product mix contains a lot of Helix exchanges, then it would have these royalties built in.
Okay, so basis our current order book, do we have such kind of products in the overall orders?
We do have, but not at the levels that we had in FY23. FY23 was really more loaded onto the licensed equipment. But in FY24, we do not see that kind of a loading on royalty.
So can we expect this?
Ma'am, I think
yes.
This is already factored into the cost sheet. So it's only, the allocation of expense that goes under a different head, but it will be part of the 22% margin, going forward as well.
Okay.
Yeah. So,
thank you,
so
sir.
these
That's
do
how
not
much.
affect our margins. These are factored in our costing when we work out.
Thank you, sir.
Thank you. Next question is from the line of Apurva from Phillip Capital. Please go ahead.
Yes, sir. Thank you. Thank you very much for the opportunity and congratulations for good set of numbers. So the first thing, it's more on like a clarification. So as we are moving from domestic to export and maybe 30% this year and 40% next year, and similarly for the product diversification from heat exchanger, heavy company to maybe wide variety of products including tower and etc. So would that have any impact on margins? Because is that so? Okay, domestic products margin is higher than or lower than the exports, and similar for the other product categories?
I would not say really, Apurva. What happens is the moment we move to exports, the chances of winnability increases because the competition level drops down. In a sense, the number of competition. That's one. And of course, on the forex side, sometimes we tend to benefit. But overall, on the profit share numbers perspective, the costing level, you may not see that kind of huge difference.
Okay. And sir, I was coming to hedging part only. So what would be our hedging policy? So would it be open or would it be partial hedging? Because if you move from 30 to 40%, and if I remember clearly, we have a fixed price contract. So, based on despite of this fixed price contract, if forex fluctuation adds up, then probably that would open up a more risk area. So, how would you see that as a risk or as a potential to benefit from the higher export?
Yeah, so I understand your question. So what we are doing today is since we are evolving on the export side and moving up in terms of the percentages, currently what we are doing is we are protecting ourselves at being conservative at the costing level right now. But as we move up now, we are going to have a case-to-case basis hedging principles moving forward. So we worked that out internally, and we would protect ourselves with the timely interventions.
Fantastic. And so just last one question on the proprietary products. So what is your thought process? How many proprietary products we may expect over the next 2 to 3 years, which can elevate the company from a current level to the next level? Because we are very ambitious on that segment as well. So can you throw some thought process for proprietary products?
Yeah, so Apurva, it will be hard for me to exactly name which are those products which we will finally be able to succeed. But I can tell you that there are 3 or 4 products which we are in discussions currently to help us move up the value chain in terms of product portfolio. So surely we should get a handle of a couple of them, but we'll wait for because it does not depend only on us. It also depends on the other side of the licensor to provide us for those proprietary items based on our past record. I can tell you today, ANUP Engineering enjoys a very good repute in terms of on-time delivery, performance, and quality. So we should be sooner than later.
So, sir, out of that, any would be exclusive or like Helix? There are other licensee as well. So, are we looking for any exclusive tie-up with global technology giant?
Our intention would be to have exclusives. But finally, as I said, it will depend on the licensor. We would prefer an exclusive license like what we have for M-Baffle technology, right? It is from Brahmane and Role, Italian company, where we have the licensee agreement, which is completely exclusive. That's the kind of contract we would prefer, but we will take it as per the licensor's recommendation. Because if the pie is large, like what Helix is, we would not mind taking that up.
Understood. Thank you very much and all the best.
Thank you so much, Apurva.
Thank you. Thank you.
Thank you. Next question is from Jaydeep from Ambit Capital. Please go ahead.
Sure. Thanks for taking my question. So just want to understand, when I look at your historical growth trend, it has been roughly a 5% top line CAGR, say from 19 to 22. So want to understand what has really driven this 40% plus growth during 23, and why do you think that the current order growth momentum that we are seeing is sustainable, and why has the oil and gas sector sort of contributed a lot to that? Your thoughts there.
Yeah, so obviously the most important factor for this growth has been the market. The capex cycle and capex cycles allows us to get this kind of order intake. The second portion is the capacity that we built up. So with the expansion of Kheda now, it throws up a capacity for us to add up to our current facility. And also third, internally, you would have seen the execution capabilities that we've brought about in terms of consistency. So market tailwind, the capacity additions that we've done, and execution excellence that we brought about internally to bring about quarter-on-quarter performance, which smoothens up the execution in terms of the final turnover.
Right. Just more nuance on that. I mean, what has really changed over the last year that there has been so much demand in the market for your products, be it exchanger, be it reactors, vessels, and everything else that you said?
Yeah. So if you see the capex cycle, currently it's like projects are announced all across, like what the earlier gentleman said. So if you've heard even the Indian government, why the domestic market is picking up, even if you listen to the Indian government, we just announced a couple of months back that we want to double our refining capacity by 2030. And now that brings about a lot of investment from public sector units like IOCL, BPCLs and HCCLs in bringing about more refining capacity, and that's where you see these projects coming up. On the other side, chemicals, you know how things have changed after the pandemic and how has been the growth story. So that is the reason why petrochemicals and specialty chemicals are picking up. So the demand on the product side is what fueling this capex. And as for me personally, if you ask me, even after the pandemic and the geopolitical scene around, every country want to be now self-sufficient and avoid importing these items. So that's the reason if you see every country would try about putting up more projects to be self-sufficient for these kind of resources.
Understood.
I would also add that the last few years are not representative of normal market conditions. I think the whole COVID pandemic disrupted the order flow significantly for quite a while. And in addition to the KEDA capex, we've dramatically added capacity both in terms of area under the crane and also what we can do under the crane in terms of higher metallurgies, higher thicknesses, higher weights. Even in our old order facility, over the last 2 years, we've done a lot of changes to be able to get a much better product mix. So the revenue per square meter, the capability to do higher on that has gone up as well. So there has been a lot of change both on capacity, market, and plus the last factor that Reggie mentioned is probably the most important. Very, very good execution to where, better and better customers are trusting us with their orders. And so we are seeing different quality of conversations going forward. So I think all of these things give a lot of confidence that this is a new trajectory that we are charting, and with the kind of capex cycles already announced, we see good demand for at least the 2 to 3 years going forward. So there's no reason to believe why this should not continue.
Understood. So this is very helpful. My last question was in terms of the competition on the exports market. I mean, who would you really be looking to replace?
So if you look at the Indian context, we would be amongst the top 4 in terms of making these complex equipment, static equipments for oil and gas. So it would be the competition among these 4, and the competitiveness that we hold augurs well for us to have a higher win rate as compared to our competition.
And I'd like to also add that, it's not all about taking a share of the pie. I think the overall pie is growing at a healthy rate. I think we are extracting more oil now than even pre-COVID. That's one data point I had. Correct me if I'm wrong, Reggie. So the demand overall in the petrochemical and refining space is likely to be strong globally. Plus, our emergence in a relative competitive landscape in India is we are well positioned both on cost and track record, especially in the last 3 to 4 years. Plus, I think India in its global position is enjoying an advantage both geopolitically and also from sort of a competitiveness perspective. So I think all those things are in favor for us to be well positioned in exports as well.
Understood. Thanks a lot for answering my questions, and all the best.
Thank you.
Thank you. Next question is from line of Rohit from Vijit Global. Please go ahead.
Yeah, thank you for giving me the opportunity. If we look at annual report for FY22, it shows company has contingent liability of rupees 175 crore in the form of bank guarantees. Are they in the form of performance-based guarantees or financial bank guarantees? And can we see these coming down in future?
Yeah, so these are the bank guarantees that we need to give in two parts. One is against advances, which we call as ABGs, and the other is we generally have to give 5 to 10% performance back guarantees, which remain for the valid warranty period. So more so it is going to be in line with this, and as we grow on our top line, it may go proportionately higher than at the current level.
So at what number are you seeing this to go further up?
It would be hard for us to predict the exact number. I'll tell you why. Because, this would all depend on the advances that we get against a particular order. Some orders would have an advances of 20%, where we will have to give an APG of only 20%. Some may have 50%. So it is in proportion to the advances that we take on the order. PPG is more so it will be 5 to 10% around that range. That do not change much.
5 to 10% of top line, you are saying?
The post PPG is the performance bank guarantees that we talk about is generally 5 to 10% of the PO value.
Okay,
yes,
sir.
So you are right, top line.
Okay, sir. Thank you so much, and I wish you the best for coming quarters.
Thank you so much.
Thank you.
Thank you. Next question is from the line of Mayasar Parikh from Native Capital. Please go ahead.
Yeah, hi. Thanks for taking my question again. On the vessels and the reactors part you have, which is expected to be 35%. One is, what are the margins on that versus your heat exchanger? And secondly, you did mention briefly, but what kind of other products are you looking at? And if you can give some idea, that would be helpful.
Hello?
Yeah, Reggie, we can hear you.
Yeah, so could you please repeat the second question, please? I couldn't get the second part of it.
Yeah, no, my second question was that, what other kind of products are you looking at, which you briefly alluded to an earlier question, besides these two new segments which are expected to grow in the next year?
Yeah, I get that. So on the vessel side, the first question that you asked on the margin side, it will not vary. Of course, it all depends on the way the negotiations are. But by and large, I would put the numbers for heat exchangers and vessels to be at the same level, and that's where our EBITDA of 22% plus would come in. On the products, what we intend and our focus is to move up the value chain in terms of metallurgy. Say, for example, today, if we are having a carbon steel, a predominant portion of it, we would want to move to exotic material because that gives us a larger turnover for the same space and the contributions that we make. So it's more about moving up the value chain in terms of the metallurgy. And the second part is in terms of the complexity. That is what we spoke about, moving into proprietary items, which would obviously come with a little better margins, but more importantly, with a lesser competition.
Okay, and what would be some of these products which can give you better metallurgy and higher complexity?
Yeah. So for example, a vessel we are making today of carbon steel, we would get a particular rupees per kg of it. We would want to move it to, say, for example, duplex or stainless steel material. So obviously, for the same amount of value addition that you do, you get larger returns in terms of your top line. And in terms of complexity, of course, moving more and more to the licensed equipment, more into the ammonia and the urea basket.
Yeah. Okay. Got it. And in terms of the competition that you mentioned, right, who are, can you just broadly name them, and also how would they rank in terms of market share, maybe in India or exports in your view?
So largely it would be hard for us because see, these are products which are custom made. There would be vendor lists which our EPCs or end customers or the licensor would project from various parts of the globe. So these competition would be around the globe, and you know who all are playing in this field and in the Indian market. So all of them would be there, the top four, and plus there would be the players in the international market which are approved in the vendor list for a customer. So it would be hard for us to pinpoint a name on the competition.
Okay, got it. And the exports are mainly to, which countries?
Yeah, so largely as ANUP today, we are focused on U.S. market. That's something which is working well for us, and also as you know, Middle East is a hotbed for oil and gas. So these are the two markets which are focused at.
All right. Okay. Got it. Okay. Thank you so much.
Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. Next follow-up question is from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Sir, when you mentioned that the contribution from KHEDA would be 60 crore for this financial year, that takes into account our top-line guidance also? This 30% growth is including the 60 crore from KHEDA or excluding the same?
Yes, this is including KHEDA.
This is including KHEDA. So 15% would be coming from KHEDA itself. Out of the total top growth, 15% will be from the new facility.
One second, let me just. So if you do the economics,
I'll work it out, sir.
You're right.
Sir, when we look at the balance sheet part, we find our borrowing for non-current liability at 30 crore and for current liability at 4 crore. So if you could explain to us what resulted in these two borrowings going up.
Hi, Nilesh Hirapra, CFO this side. So for KHEDA expansion, we have drawn out around 34 crore as a loan. So out of that, 4 crore installment would be due during this year, and rest would be in the rest of installment. So those amount which will be due in the next financial year, that is FY24, has been shown as the current borrowing and rest against non-current borrowing liability. Just to add one line, at the end of a year, as on 31st March, we have been almost net debt-free. That is like negative balance of 1.34. So cash balance plus debt is roughly negative 1.34 crore.
Okay, and what is the cost of funds, sir?
So 8.5%.
8.5%. And the fund which and also we are expecting certain percent of interest redemption subsidy from Gujarat Industrial Policy. So that would be roughly redemption of around 7% interest from the government, which would be equal to the 1% of capex cost. So that will bring down our capex loan cost. Sir, if you could explain it once again.
So loan incentive, 8.5%.
Yes, sir.
Right? And we'll get interest subsidy from the Gujarat government, which would be nearly 7% interest cost. But in total, it would be 1% of a capex cost. So in total, we'll get a reimbursement of around 1.2, 1.25 crore as interest.
Okay. So what does the policy entail, sir? It gives us a subsidy of interest subsidy of 7% on. If you could entail the nitty-gritty of the subsidy part from the government.
Yeah. So government is financing 7% capex loan. The total subsidy would be the 1% of capex. So suppose we are closing Kheda capex at 120 crores, we'll receive 1.2 crore as a capex subsidy.
1.2 crore, 1% of this.
Yeah, that's correct.
Okay. Thank you, sir.
Thank you. Next question is from Tushar from Komakia Wealth Management. Please go ahead.
Yes, thank you for the follow-up opportunity. Sir, I understand our competition like Godrej and Bonds, L&T and Patel ASM. So, sir, I just want to understand what different we do in ANUP compared to those guys. And, sir, I understand the pie itself is increasing. So, what make us, help to get such a high export target, like from near to 18-19%, we are targeting to 40%. So I just want to understand your thought on that.
Yeah. So Tushar, if you look at the product portfolio that we deal with, most of these are customized product static equipments that we make. And here the past track record in terms of our on-time delivery performance and quality plays a very important role. So yes, the pie is definitely better based on the capex cycle today. But for us to be having that growth path and with a decent margin profile, we have to hit the right product and win the right order. That's where the credibility in terms of your past performance and a good repute with customers will play. And I think that's where ANUP comes at the top in terms of having a good track record and relationship with the customers, especially in terms of on-time delivery performance.
I think also there's an element of the past being a capacity constraint environment where we didn't have to look very far beyond domestic orders that were of very high quality. So now with more capacity, with enhanced capability, we can also pick up very discerning orders from very discerning clients abroad. And I think the sort of effort to gain more export volumes has been ratcheted up for the last year or so, and that is now paying dividends. So the growth and the capacity expansion and capability expansion has also led to this directionality of higher exports.
Yeah, and also to add to what Puneet Bhai said, with the Kheda facility now at our disposal, it's bang on the highway. So it opens up now a larger product basket for us. Say earlier in Odhav, we had a limitation in terms of the height of the equipment that we could move out, mainly because it is landlocked because of all the flyovers and being in the city. Now this new facility has opened up that channel for us where we could move equipment even up to a diameter of 7.5 meters. So this opens up a larger basket for us, and that's what customers desire. They don't want us to pick and choose product. They would want that we actually address the whole inquiry basket for them. So earlier, there were cases where we had to say no to a customer because we did not have this facility and we couldn't move out from our order facility. Whereas now it opens up the gate for us to accept whatever inquiries that customer can give in. So this all put together puts us in a very strong position in terms of export market.
Yes, sir. One last question. From the green hydrogen opportunity, do we manufacture any product catering to green hydrogen? And what sort of growth we are seeing on that?
Yeah, so green hydrogen, we all know it's the next energy mix that we all are going to move. Of course, there are some challenges right now, but sooner than later it will be addressed. But a direct answer to your question, Tushar, is on the generation side, we don't play a role because green hydrogen is basically electrolysis and other part where we don't have a role. But once the hydrogen is separated out from water, that's where our role comes in terms of storage and transportation of hydrogen. And to clarify, we are already into that business today. We are already making these equipments for some of the customers as and when the opportunity arises. So a short answer, yes, we are not on the generation side. We are on the transportation and transmission side. And on that side, we are already there into this business.
So the line for the participant dropped. We move to the next question. Next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. So I just wanted to know the exotic metallurgy part which we are going to do. What actually drives the demand for this sort of material and in which industry does it get used?
So generally, these exotic materials you would find more and more usage in specialty chemicals, and that's the sector, as you know, which is booming right now. So that is bringing about the change. And if you remember, probably if you heard our earlier calls, we used to talk about this clean room. Now this clean room is exactly meant for these kind of equipment. So we have prepared ourselves for this kind of order intake. And now with this capacity that we built in, which we have commissioned about 4 to 5 months back in order, we are now going to customers seeking orders for this clean room.
Okay, so currently do we have any orders for this sort of material?
At the moment, no, we are not executing, but we have a handful of inquiries where we are quoting and trying to back.
Reggie, we do have a lot of exotic material inquiries, perhaps not clean room grade, but exotic metals is a big basket, right?
Yeah, in terms of Concall and others, but I think the main question, if I understand correctly, it was on the titanium side, probably because of the clean room. That's the reason I was trying to answer that.
Sure.
So on the titanium side, we don't have a order right now. We are not executing. We are having inquiries which we are targeting to receive, but from the other higher metallurgy basket like duplex, Concall, we are already making, and we have a handful of them right now under execution.
Okay, and so you did mention that we are trying to double the refining capacity by 2030. So what sort of capacity, what sort of opportunity does lie ahead of us in terms of heat exchangers, vessels, and the products we deal in? If you can just give some metric, there is a capex of around 1,000 crores happening. Out of that, how much pie would come to us in the market? As in, what sort of opportunity is there?
Yeah. So what I said was India, which has articulated this vision a number of times that we want to double our refining capacity. So it will see a lot of refineries coming up. You would have heard in the news, even the Ratnagiri, one of the largest refining project that is being talked about. That's also now on the discussion. So these kind of refining projects would come. In terms of what is the kind of opportunity that we have, say for example, the example that you gave, 1,000 crore comes in. Static, generally in the product portfolio that we as ANUP Engineering would be interested in, because there are some products where we are not qualified, some products which we are not interested in because they are too small. So the pie that we would be interested in is roughly about 2.5% to 3%.
Okay. And out of that, if I did get it right, 15 to 20% is the conversion of the bid pipeline, right?
That is correct. So if you see any project, refining or a petrochemical project being announced, you would see a number of, say, one or in between $1 and $2 billion kind of a project. So roughly about 7,000 to 13,000 crore worth of projects. So that's the size of the project, out of which the product portfolio that we would be interested in would be roughly about 2.5%.
Yeah, that's it from my side. Thanks and all the best.
Thank you so much.
Thank you very much. I now hand the conference over to Mr. Reginald D'Souza for closing comments.
Yeah. So thank you so much, everyone, for a very interesting and interactive session. We were quite happy responding to all the queries and clarifications that you wanted. So I'm sure going forward as well, we will have your understanding, support, and guidance as we take this journey towards a glorious future, creating a win-win for all our stakeholders. So once again, a big thank you and take care.
Bye-bye. All the best.
Thank you very much. On behalf of the ANUP Engineering Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.